Somewhere in a filing cabinet or buried deep in a database you forgot existed, there's a lien on your house and it just woke up. We are talking about zombie mortgages, the financial undead that are rising from the grave and knocking on the doors of homeowners who thought they were free and clear over a decade ago. So what exactly is a zombie mortgage? And how does something like this even happen? Picture a second mortgage or home equity loan that went silent during the 2008 financial crisis. A debt that collectors stopped pursuing, that banks wrote off, that borrowers simply stopped hearing about until now. Back then, millions of Americans took out piggyback loans, those secondary liens that sat behind a first mortgage and helped buyers avoid private mortgage insurance or cover a down payment they did not actually have. When housing prices collapsed and servicers were drowning in defaulted first mortgages, these junior liens quietly fell through the cracks, unpursued, unresolved, and technically still very much alive. Here is the brutal irony. You may have assumed that silence meant forgiveness, but in the legal world, silence just means someone was not paying attention yet. These debts never actually died. They were simply dormant, collecting dust in the portfolios of debt buyers who paid pennies on the dollar for them and waited for the right moment to strike. And that moment, apparently, is right now. Home values have surged dramatically since the pandemic, which means equity has returned to properties that were once underwater. And suddenly, those old zombie liens are worth pursuing again. Think of it like a parking ticket you got in 2009 that the city forgot to mail. And then in 2024, they found the ledger, hired a collections firm, and started adding 15 years of interest on top of it. Homeowners are opening certified letters demanding tens of thousands of dollars on loans they genuinely believed were resolved. And some of them are facing foreclosure threats over debts they did not even know existed. The Consumer Financial Protection Bureau flagged this growing issue, noting that many of these loans were bundled into mortgage-backed securities transferred between servicers so many times that no one was clearly in charge, until a debt collector bought the note for a fraction of its face value and decided to cash in. We are seeing reports of borrowers being contacted about second mortgages from 15 or even 18 years ago, with balances that have ballooned through compounding interests into figures that are almost unrecognizable from the original loan amount. Now, here is where the misconceptions pile up, because a lot of homeowners assume that if a debt is old enough, it simply cannot be enforced, and that is not entirely wrong, but it is dangerously incomplete. Statutes of limitations on mortgage debt vary by state, and critically, a lien on real property can survive even if the servicer loses the right to sue you for the balance, meaning they may not be able to take you to court, but they can still cloud your title and block a sale or refinance. That distinction matters enormously, especially if you are planning to sell your home, pull out equity, or refinance into a better rate, because a title search will expose every lien on record, and a zombie mortgage can stop the transaction cold. The good news is that knowledge is the first line of defense, and pulling your title report proactively, rather than discovering the problem at the closing table, gives you time, options, and leverage. Historically, periods of rising home equity have always attracted old debt back to the surface, and the pattern is almost predictable. Prices rise, equity builds, and dormant claims find new life because the math finally makes it worth someone's while to collect. We saw echoes of this after the savings and loan crisis of the 1980s and 90s. And the lesson each time is the same. Ignoring a debt does not extinguish it, it just postpones the confrontation. If you have ever had a second mortgage, a home equity line of credit, or any kind of junior lien, especially one that went quiet around 2008 through 2012, you owe it to yourself to do a title search and verify the status of every recorded instrument against your property. And if a zombie mortgage does appear, your options may include negotiating a settlement for less than the full balance, challenging the enforceability based on your state's statute of limitations, or disputing the chain of title if the debt has been transferred so many times that ownership cannot be clearly established. The philosophical lesson here is one that applies to personal finance broadly. Unresolved problems do not disappear. They simply wait for a more inconvenient time to resurface, usually when the stakes are higher. Discipline in this context means not assuming silence is resolution, staying organized with your financial documents, and treating every lien like it is alive until you have written proof that it is not. The homeowners who will navigate this era best are not the ones who panic or ignore the letters, but the ones who respond methodically, consult professionals, and treat this as a solvable problem rather than a catastrophe. Size your response to the actual risk. Get informed before you get emotional. Because in most cases, these situations are negotiable if you engage early and strategically. There is something almost poetic about a debt called a zombie, because just like in every story involving the undead, the real danger is not the monster itself, but the moment you stop paying attention. Stay current on your title. Know what is recorded against your property, and never assume that a creditor's silence equals forgiveness. Whether you are dealing with a zombie mortgage, trying to build equity the right way, or looking to invest in real estate with eyes wide open, we can help you get started in real estate investing, connect you with home contracting professionals, and find the right lenders. Check out our links in the description below.